This is what really happens, where a bank repossesses a home. Indeed, one day it may be your home. The bank's first priority is to recover the house and sell it quickly, and often claims it has done this at below market value. Yet it still holds the borrower, mortgagee, liable for remaining debt. While it may seem unfair, the process is driven by the way mortgages, securitization, and insurance work in practice, and it's geared to protect the bank, not you. Let's look at the key components of a mortgage transaction and break it down to show you why this happens. Stage 1. Securitization and Special Purpose Vehicles, SPVs. Very few people know about this section of how mortgage profits are made by a bank. When a bank securitizes a mortgage, it packages it with other mortgages and sells it to a special purpose vehicle, SPV, which is just a confusing name for a company, which in turn issues securities backed by those loans. However, the bank's sale of the mortgage to the SPV and having been paid in full doesn't mean the mortgage has been paid off, in the sense that the borrower is released from their obligation to repay the loan. The borrower is still required to make payments on the loan, as the legal debt continues to exist, because you signed a contract to make payments for many years, but the payments now flow to the investors who bought the securities, because your bank has already been paid in full. Stage 2. Repossession and forced sale and scale of losses to a bank. If a borrower defaults on their mortgage, the bank, or the SPV, but often through the bank acting as a servicer, has the right to repossess the property. Once repossessed, the property is usually sold at a forced sale or auction, often at a significant discount, around 60 to 70% of market value, which is the forced sale value. This forced sale price is typically lower because the bank wants to recover the debt quickly. Forced sales normally tend to happen under market pressure or distressed circumstances, leading to lower prices, banks claim. However, this is not always true. Stage 3. Remaining debt after sale. When the bank sells the property at a discount, the proceeds from the sale may not fully cover the outstanding loan amount. For example, if the loan was $200,000 but the property sold for $120,000, there is still an $80,000 deficiency. The borrower remains legally liable for this deficiency balance, the difference between the sale price and the outstanding loan amount, even though the loan may have been insured at 120% to 150% of its market value. Stage 4. Insurance against default, mortgage insurance. As mentioned, that banks often have insurance on these loans, sometimes covering 120% to 150% of the loan value in the event of default. This could refer to either private mortgage insurance, PMI, or other forms of credit default insurance. How mortgage insurance affects you. If the borrower defaults, the insurance compensates the bank, or the SPV, for a portion, the full amount or more than the outstanding balance of the loan. However, the insurance payout is meant to protect the lender, not the borrower. The investors have substantial recovery issue. It may seem like the bank is being compensated 4 times, once from the insurance, second from the selling of the secured bond, and third from selling the property, and fourth by getting a court order and making you pay the difference between the forced sale value and the outstanding loan amount, even though the bank may have been paid in excess of the loan value. The insurance payout to the bank doesn't necessarily eliminate the borrower's legal obligation to repay the loan. Stage 5. Why does the bank still pursue the borrower for the deficiency? The reason the bank or lender can still pursue the borrower for the remaining debt, the deficiency, even after the loan has been securitized and insured, is because there is a contractual obligation. The borrower signed a loan agreement to repay the full loan amount, and defaulting doesn't automatically eliminate that obligation. The loan agreement usually stipulates that the borrower is still liable for any remaining debt after the sale of the property. Insurance protects the lender, not the borrower. The bank or lender may have been compensated by insurance, but this doesn't change the borrower's legal responsibility. Insurance is typically structured to cover lender losses, not to benefit the borrower. Legal protections vary by country. In some places, like certain U.S. states, with anti-deficiency laws, lenders may be prohibited from pursuing the borrower for the deficiency after foreclosure. However, in many jurisdictions, banks have the legal right to seek repayment for the full loan amount, even after a repossession and forced sale. 6. Justification for this practice. While this process might appear unjust, particularly if the bank benefits from multiple sources, the sale of the property, insurance, and pursuing the borrower, the justification is often grounded in the legal structure of loans and mortgages. Lender's risk mitigation. The bank or lender takes on significant risk when issuing loans, especially in a securitized system. Insurance is used as a risk mitigation tool, but it doesn't cancel out the original debt owed by the borrower. Legal obligation. The borrower's obligation to repay the full amount of the loan is based on the contract they entered when they took out the mortgage. The lender's pursuit of the deficiency is legally permitted based on this contract, and the insurance is simply a tool for covering potential losses. Cost recovery. The bank may still face costs in the repossession process, legal fees, sale expenses, etc., and the forced sale of the property often doesn't fully cover the loan balance, so the bank pursues the deficiency as part of its recovery process. There is criticism and reform happening in some countries, but not in the UK. This process has been widely criticized for being unfair to borrowers, especially when banks are perceived to be benefiting from insurance or securitization and collecting the balance of the debt. Critics argue that the borrower shouldn't be held liable for the full deficiency after the lender has been compensated through the sale of the mortgage or bond, giving 100% recovery of the loan, collecting the insurance, which could have been as much as 150% of the loan, and then selling the home at a huge loss, after which they take additional assets through court proceedings. The process creates a moral hazard where banks are incentivized to repossess and sell properties quickly, knowing they are covered by insurance and have already been paid. But this is where greed prevails. Everyone, the broker, the mortgager, and the investors have all been paid in full. In response to such concerns, some countries have introduced anti-deficiency laws or have sought to better regulate how lenders handle defaults and repossessions. In conclusion, a summary of what people face: banks repossess homes and sell them at a discount, forced sale value, when borrowers default. But this does not cancel the borrower's debt. Even if the loan was securitized or insured, the borrower remains contractually obligated to repay the loan balance. Insurance compensates the lender for losses, but the borrower is still legally liable for any deficiency. While this system is justified by the structure of lending and risk management, it raises ethical and fairness concerns, leading to calls for reform in how defaults and repossessions are handled. And now, if you understood from video 3 there was actually no money or real asset given to you, in the first instance, you may be a little concerned. Sohail Hashmi and his visionary banking team believe it's time to protect you. Not just the lenders. There is no need to lose your home. It's time to discover a new way forward.